Are you thinking about buying a home but aren't sure which mortgage is right for you? Hey there. Today, we're talking about adjustable rate mortgages, or ARMs. Are they a smart choice in 2025, or are they too risky? In this video, we'll cover what an ARM is, how it works, the pros and cons, and whether it might be a good fit for you. Let's jump in. An adjustable rate mortgage is different from a traditional fixed rate mortgage. With a fixed rate loan, your interest rate stays the same for the entire term of the loan. But with an ARM, the interest rate can change over time. Most ARMs start with a fixed rate for an initial period, usually 5, 7, or 10 years. After that, the interest rate can adjust up or down based on the economy and market conditions. This means your monthly mortgage payment can increase or decrease over time. Let's break down how an ARM works. If you get a 5-1 ARM, the 5 means your interest rate stays the same for the first 5 years. The 1 means your rate can change once a year after that. When the fixed period ends, your new rate will be based on a financial index, plus a small extra amount called a margin. If interest rates go down, your mortgage payment could decrease. But if interest rates go up, your payment could increase. That's why some people see ARMs as risky, while others see them as a way to save money in the short term. So, is an ARM a good idea in 2025? Let's take a look at the pros and cons. One of the biggest advantages of an ARM is the lower initial interest rate. Since the starting rate is usually lower than a fixed-rate mortgage, your monthly payments are more affordable at the beginning of the loan. A lower payment can also give you more buying power, allowing you to qualify for a larger loan and potentially afford a more expensive home. Another advantage is that an ARM can be a great option if you plan to sell or refinance before the rate adjusts. If you only plan to stay in your home for a few years, you might never have to deal with a rate increase at all. And if interest rates drop, your payment could actually go down after the initial fixed period. But there are also some risks to consider. The biggest concern is uncertainty. Once the fixed period ends, your interest rate can increase, and that means higher monthly payments. This can make it harder to budget, since you won't know exactly what your mortgage payment will be in the future. Another potential downside is the cost of refinancing. If you want to switch to a fixed-rate mortgage later, you may need to refinance, which could mean additional fees and closing costs. So, should you choose an ARM in 2025? That depends on your situation. An ARM might be a smart choice if you plan to sell or refinance before the rate adjusts, if you're comfortable with some risk, or if you want to take advantage of lower initial payments. But if you prefer long-term stability, plan to stay in your home for many years, or don't want to worry about changing interest rates, a fixed-rate mortgage might be the better option. At the end of the day, the right mortgage depends on your financial goals and comfort level with risk. If you're still unsure which loan is best for you, we're here to help. For more information, be sure to connect with us.